Hello, global wanderers and tax-savvy travelers. Welcome back to Bazillions, where we dive into the world of making money, living anywhere, and of course, smart ways to handle your taxes as a digital nomad or expat. Today, we're exploring essential tax-saving strategies that could save you a bundle while living your dream abroad. So buckle up and let's get started. I'm not a tax professional or lawyer, so understand that this is information as I know it, and you would want to talk with your tax or legal professional to see how this applies to you. That being said, I can tell you that probably 90% or more of tax and legal professionals are not versed in this information, so I suggest you find someone who specializes in expats. First things first, understanding your tax obligations is crucial. As a U.S. citizen or resident, you're taxed on your worldwide income regardless of where you live or earn your money. This means the IRS wants to know about every penny you earn, whether it's from a beach in Bali or a cafe in Paris. However, there are ways to minimize what you owe through what's known as the Foreign Earned Income Exclusion, or FEIE. For 2024, this allows you to exclude up to about $126,500 of your foreign earnings from U.S. taxes, provided you pass either the Bona Fide Residence Test or the Physical Presence Test. So what's the Bona Fide Residence and Physical Presence Test, you ask? The Bona Fide Residence Test applies to U.S. citizens or resident aliens who reside in a foreign country for an entire tax year or for a period that includes an entire tax year. To meet this test, you must demonstrate that you have established a bona fide residence in a foreign country. This typically involves showing that you have made a home in the foreign country and have integrated into the local community. Factors that may be considered include your duration and purpose of your stay abroad, establishment of a home in the foreign country for an indefinite period, participation in community activities, nature and duration of your employment, family and economic ties to the foreign country versus the United States. Meeting the Bona Fide Residence Test allows you to exclude a portion of your foreign income under the Foreign Earned Income Exclusion. It's important to note that short or temporary trips back to the U.S. do not necessarily negate a bona fide residence as long as you clearly intend to return to your residence abroad. The Physical Presence Test is more straightforward in its requirements compared to the Bona Fide Residence Test. To meet this test, you must be physically present in a foreign country or countries for at least 330 full days during any period of 12 consecutive months. The 330 qualifying days do not have to be consecutive, but they must be completely within the foreign country or countries. Some key points to consider. Any time you spend traveling over international waters or in airspace without landing in a foreign country does not count towards the 330 days. Days spent in the U.S. during the 12-month period cannot be counted towards the 330 days. This test is purely numerical, focusing on the number of days spent abroad regardless of your employment or residential status in the foreign country. Both the Bona Fide Residence Test and the Physical Presence Test are crucial for claiming the Foreign Earned Income Exclusion. This exclusion significantly reduces the taxable income for U.S. expats and can be a major factor in financial planning and tax strategies for digital nomads and expatriates. In addition to this, there is also a foreign housing exclusion or deduction. Any U.S. citizens who live outside the U.S. and earn wages or self-employment income in a foreign country qualifies. It covers reasonable expenses paid or incurred for housing in a foreign country, which includes rent, utilities, except for telephone charges for some reason, real and personal property insurance, leasing fees, furniture rental, and repairs. It doesn't include expenses that are lavish or extravagant under the circumstances, and costs of buying property are not eligible. So by my calculations, this amount is 16% of the FEIE amount for the year. So that would be 0.16 times $126,500, which comes out to $20,240 for 2024. To claim the foreign housing exclusion or deduction, you must file Form 2555 or 2555EZ, which is the same form used to claim the FEIE. This exclusion can significantly increase the amount of income that can be shielded from the U.S. taxes, especially in countries or cities where living expenses are high. It's an important consideration for expats in planning their tax strategies. Next up, establishing tax residency in another country. Many countries offer favorable tax treatments to attract foreign residents, like Portugal's non-habitual resident regime or Malaysia's My Second Home program. By establishing tax residency in these countries, you might benefit from reduced tax rates or special exemptions. But be careful, navigating dual tax residency can be tricky. Always consult with a tax professional to ensure you're not only compliant, but also maximizing your benefits under each country's laws. International tax treaties are also your friend. These treaties between countries can help prevent double taxation. That means if you pay tax in one treaty country, you can often offset that against taxes owed in your home country, potentially reducing your overall tax burden. For example, if you're paying income tax in Germany, you might not have to pay that same tax to the U.S. government. Again, a qualified tax professional can help you navigate these treaties effectively. For example, Italy introduced a special tax regime for retired expats who moved to the southern regions of the country. To qualify, individuals must move to a municipality with fewer than 20,000 inhabitants in regions such as Sicily, Calabria, Sardinia, Campania, and I don't know if I said that right, on Basilicata, Abruzzo, Molise, and Puglia. The incentive offers a substitute tax on foreign income set at a flat rate of 7% for up to 10 years. To be eligible, expats must not have been tax residents of Italy for at least 5 of the last 6 years before moving to Italy. Spain has something referred to as the Beckham Law, initially made famous by David Beckham. This law allows qualifying expats, typically high-earning employees or self-employed individuals, to opt for non-resident taxation despite being tax residents. Under this regime, income earned in Spain is taxed at a flat rate of 24% up to 600,000 euros and 47% thereafter. However, foreign-sourced income is generally exempt. This can apply for up to 6 years. Then we have Portugal with their non-habitual resident regime. Portugal offers a 10-year tax regime for non-habitual residents. Under this program, qualifying expats typically pay a flat rate of 20% on Portuguese-sourced income from high-value added activities and are exempt from taxation on certain types of foreign-sourced income, such as pension income, depending on the tax treaty with the source country. The regime aims to attract skilled professionals in high-value fields and retirees with pensions. Next up is Greece with their tax incentive for foreign pensioners. Greece recently launched a tax incentive aimed at attracting foreign retirees. Under this regime, foreign pensioners who transfer their tax residence to Greece are subject to a flat tax rate of 7% on their foreign-sourced income. To qualify, pensioners must not have been tax residents of Greece for 5 out of the 6 years preceding the transfer of their tax residence to Greece. These programs are part of a broader trend where countries are competing to attract affluent individuals who can contribute to the local economy without adding a strain to employment markets. Each program has specific requirements and conditions, so potential beneficiaries should carefully review the rules or consult with a tax advisor to understand the implications fully and ensure compliance. Navigating taxes as a digital nomad or expat doesn't have to be a headache. With the right strategies and some savvy planning, you can significantly reduce your tax burden and keep more of what you earn while enjoying a lifestyle of freedom and adventure. Don't forget to hit the like, subscribe, and bell notification for more insights on living smartly abroad. Share your experiences or questions in the comments below. I'd love to hear how you're optimizing your taxes on your journeys. Until next time, keep exploring and stay savvy. Thanks for watching. Check out my other videos for more tips on making money and saving smartly wherever you are in the world. See you in the next video.